Ever found yourself scratching your head as prices skyrocket and economic uncertainty takes center stage? Well, you're definitely not alone. Welcome back to Wealth Wizards, and for today, we're diving headfirst into a topic that's hotter than hot: the enigma of skyrocketing prices and the financial roller coaster we call inflation. But fear not, because, well, we're here to help. Think about it. When prices seem to have a mind of their own and the economy's feeling a bit like a wild rodeo, how can we keep our financial ship sailing smoothly? That's the question of the day, and we're here to share some insights along with an understanding of Warren Buffett's investing principles. So before we go on, hit that like and subscribe button to keep seeing more of our content. But other than that, let's get started. Starting off with number 1, delving into Warren Buffett's investing principles. Warren Buffett is well known for his exceptional abilities and business expertise. He avoids short-term gains and investing trends by taking a patient, long-term view with his valuable assets. He has a knack for locating undervalued assets, which is why Buffett's extraordinary success is no fluke, as proven by his impeccable track record. His instincts, discipline, and ability to see through the noise help him successfully navigate the volatile market. When the market fluctuates, Buffett's principles do not. He isn't fazed by the day-to-day ups and downs and instead concentrates on the long-term success. His resolute determination is inspiring, like someone riding a roller coaster with their eyes fixed on the prize at the end of the ride. In the midst of uncertainty, Buffett's investment principles can serve as a source of solace by serving as a reminder to focus on the future, look for value, and hold steady. It's about realizing lost opportunities and maintaining integrity. Buffett's concepts of long-term value, identifying hidden possibilities, and charting paths to victory can provide guidance as we navigate the choppy waters of the market. Spending time in the market is more important than entering at the right time. Number 2. Unpacking the concept of inflation. The economy feels the effects of inflation when prices rise and the value of money drops. Just think about how inflation might affect your ability to buy your daily cup of coffee. Everything is affected, and prices rise gradually as a result. To what end does inflation occur? A possible reason is the higher rate of currency exchange. When there is more money available, costs may rise. Factors such as production costs, surges in demand, and world events all have a part. Inflation eats away at financial reserves, lowers purchasing power, and causes havoc for enterprises. High inflation requires investors to make strategic changes. Perhaps traditional approaches may not help, but proactivity is essential during this time. Because of the difficulty of dealing with inflation and the need for flexibility, it is important to explore the strategies needed to navigate these times. That we will be discussing later. Number 3. Emphasizing pricing power. Paying close attention to pricing power, which is the capacity of some sectors or businesses to increase prices without suffering a loss of clients. During times of high inflation, it acts as a protective shield, much like a superhero would use a cape. Companies in the utility industry can increase prices during times of inflation because of the consistent demand for utilities such as electricity and water. Products in the energy and consumer staples industries also have pricing power because of the indispensable nature of their goods. Investing in firms with strong brands, dedicated clientele, and a unique selling proposition is a surefire way to capitalize on this trend. These characteristics indicate a propensity for the company to respond to rising inflation by adjusting prices. Think of pricing power as a protection against the risk of inflation when you evaluate potential investments. Coming up with number 4, we delve into dividend stocks. These aren't your average stocks. In addition to capital growth, you'll also receive regular dividend payments. You're in for a real treat if you put your money into a firm that has a track record of strong growth and profit. Here's the deal. As a shareholder, you're due a dividend payment from the company's earnings. These fixed payments protect you from the eroding impacts of inflation. Consider it an umbrella for your money. Meanwhile, Buffett has a remarkable ability to select dividend-paying firms. His investment record shows how well he grasps the significance of a regular paycheck. His dividend icons include both consumer and finance industry heavyweights. Instead than getting caught up in the market's turbulence, dividends provide a steady and sure way to grow wealth. Consider the appeal of dividend-paying equities when inflation poses a danger to your savings and investment strategies. They're reliable even in the midst of chaos. Make sure to follow Warren Buffett's lead and put your money to work for you. Take to heart his advice: buy when everyone else is selling and hold when everyone else is buying. Moving on to number 5, let's talk about bonds and inflation-protected securities. Now, why should you invest in inflation-protected securities? You may compare it to lending money to a firm or the government, as that is exactly what a bond represents. They say they'll pay you back and then some, which sounds great. The catch is that inflation might reduce the purchasing power of those supplemental payments. In this situation, inflation-protected securities save the day. These ingenious investments automatically change their value to account for inflation. Therefore, your investments will increase in value alongside the market. It's like taking a look into the future where prices are concerned. Even with this protection, there are still some hazards to watch out for. One factor is the change in interest rates. As rates rise, bond prices usually fall, like attempting to maintain balance on a seesaw. Market conditions also play a role, as bond and inflation-protected security prices fluctuate in response to market forces including supply and demand. It's like being on a roller coaster when you least expect it. However, bond portfolio diversification can help you manage these dangers. It's similar to building a fortress with several layers of protection. You can create a safety net between yourself and potential losses by investing in bonds of different maturities and from different issuers. So keep your cool if inflation hits. Safety and security can be found in bonds and inflation-protected assets. You should just keep your eyes open, diversify responsibly, and proceed with assurance in the market. In strategy number 6, we'll delve into investing strategies for high inflation. Imagine a world where inflation is rampant and your investments are like gazelle trying to outrun a pride of lions. Put your money into real estate and precious metals, which are resilient to inflationary price swings and can serve as a stable foundation for your investment portfolio. Take advantage of pricing power by backing firms that may raise prices to safeguard earnings. Stocks and bonds that provide dividends can be useful allies in combating inflation by helping to keep your purchasing power stable. Bonds and inflation-protected securities become a well-kept secret, providing insurance against rising costs. By adopting real estate, enterprises with pricing power, and bolstering investment portfolios, you can better prepare yourself to weather the effects of inflation. Adapt, seize chances, and emerge victorious from the difficulties brought by rising inflation. And now for number 7, diversification. Imagine a portfolio of investments that cover all bases. Keep your options open. Don't put all your eggs in one basket. That's sound investment advice, one that even Warren Buffett agrees with. It's like having a cushion to fall back on if the stock market crashes. Putting all your eggs in one basket, so to speak, is the equivalent of betting the farm on a single horse. But diversification is the right move. Imagine putting together a group of superheroes, each with their own special abilities. Diversification's power during inflation comes from avoiding exposure to any one asset. You diversify your holdings, increasing the likelihood that some of them will do well even if inflation is high. It's like having an army, with each soldier prepared to face a distinct threat. Some industries may suffer amid inflation, while others will likely thrive and serve as bright beacons. By spreading your resources around, you may better capitalize on a rising tide of prosperity. Warren Buffett understands the importance of diversification like a few others. It has worked brilliantly for him as an investor. Make sure to invest in a wide range of securities, including equities, bonds, real estate, and precious metals like gold and silver. Try out new fields and jump at international chances and build a strategy that can withstand every challenge. As we wrap up this deep dive into high inflation strategies, it's evident that adjusting your investment approach in the face of inflation is similar to skillfully riding a turbulent wave. From understanding economic fluctuations to heeding Warren Buffett's wisdom, we've gained several valuable tools. Always remember that adaptability is paramount when confronting inflation's effects on your investments. Don't forget to give that like button a friendly tap, share this video, and hit subscribe to ensure you're always in the loop for more of our content here at Wealth Wizards. Your thoughts matter too, so share them in the comments below. But for now, thanks for joining us today, and we'll see you in our next video.